Welcome to the Texas Local Lender Channel. I'm William Branch. Thank you for tuning in. Today we are talking about self-employed borrowers and what it takes to get a mortgage. So what is a self-employed borrower? Self-employed means that you are either 1099 or you actually own your own business. Being in the business world, owning your own business is fun. It's got its perks. But also when it comes time for a mortgage, there are some hurdles that we sometimes can face. First, just kind of want to talk to you about typically how somebody is paid. When as a lender, being self-employed, the first thing we're going to ask is, are you self-employed? Do you run your own business or do you work for somebody? In the case that we're talking about self-employed borrowers today, we are going to have to first request your tax returns and gather all of your information. Typically what we're looking for is that you've been in business for at least 2 years. Do you always have to have 2 years worth of tax returns to be able to purchase a home being self-employed? That answer would be no. With self-employed borrowers, we find a lot that, you're going to have all of your gross revenue that you've generated. Let's just use, we'll say $100,000. And then you have all of your expenses. You have your telephone expense. You have depreciation on your car that's able to be tax deductible. You have other expenses, maybe office or insurance or whatever it may be. These are things that are deductions off of your income, whereas the typical W-2 employee is going to have their taxes taken out of their regular paycheck on each paycheck that's already paid to the IRS. Typically, when you file your returns, you're either going to get a refund or you're going to actually owe money to the IRS. That's one thing that we're going to find out, that if you do owe money, we are going to have to also document that you've paid that check and source the funds that you've paid the money to the IRS. Being self-employed, one of the things that we're going to ask is, how do you file your taxes? Are you a Schedule C? Are you a sole proprietor? Are you a partnership? Or do you have a corporation? So these are the types of things that we're going to look at, and it tells us what do we need. Typically, we're going to need your personal 1040, and then on your Schedule E, you'll have your partnership returns or your S Corp corporations. So that'll tell us whether we're going to need K1s, and then also have to have all the business returns. So any business that you have on those tax returns, on your personal return that's listed in your Schedule E, is going to have to be required. So make sure that if you have any businesses that are on that return, that you don't give them one, that you're going to give them all the business returns that you have. As far as a lender, what we're looking at is typically most lenders will run your file through a LoanBeam or Income Genius, or if you can do it the old-fashioned way like myself, typically we have an income calculator that will generate all of your W-2s if you're self-employed, or Schedule C, however it may be. We can run that calculation and figure out what is your net income after all of expenses. What does a lender look for on your tax return? So they're going to be looking at your gross income for one, and then from there you have all of your expenses. You have meals and entertainment, you're going to have depreciation, you may have a car and truck expense. All of that's going to funnel down to a net income. One thing that can cause a problem would be if you have loans that are due in less than 12 months. So that can, if you don't have the funds to cover those notes due and payable, or if they're not going to renew, that can reduce your net income to qualify for a house. One thing a lender is also going to need is considered tax transcripts. So you have your normal tax return that you're going to be filing, and then you have what's called a tax transcript. So you're going to send your tax returns to the IRS, and then what happens is lenders can pull your tax transcripts online, or they sometimes will ask you to go to the irs.gov and actually pull your tax transcripts for the last 2 years. So what that is, it's a carbon copy of what you filed, and it's for the investor, for your servicer, Chase, Wells Fargo, BB&T. Typically, they're going to require transcripts. So do you have to have transcripts in a loan? Answer is no. We can actually sell that direct to Fannie Mae or Freddie Mac and not actually have transcripts. There are times when we can't get those transcripts back from the IRS, and that can pose a potential problem. It's not necessarily a problem, but it could affect your interest rate if you do have to sell direct to Fannie Mae and Freddie Mac. One thing that I see a lot on tax returns is that there's not a whole lot of net income, or there's not a whole lot of income to actually use on a tax return for a self-employed borrower. So does that necessarily mean that you can't get a loan? That answer is no. you can get a loan. There's a potential for us to be able to do that. And what that is we've covered this in other videos, is actually a bank statement loan that there's no tax returns, there's no pay stubs required. And what they're going to do is we're going to gather 12 to 24 months worth of personal or business returns, depending on how you get paid. Gather up an income figure based on your deposits. Typically, depending on what kind of business you're in, they will do some kind of deductions, whether it's 20, 30, 50, or 70% based on the type of business that you're in. But we can actually generate an income figure based on just your bank statements alone. So if you are self-employed, don't be afraid that there are solutions on those bank statement programs. You're typically going to have 10% down on those programs. So just keep in mind, if you do write off all your expenses, that you are going to probably have to put some money down on that. You're looking at lower the credit score on that's going to be about 680 FICO. And so there are options, so don't be discouraged. Make sure you talk to your lender, ask them some questions, and if you are looking to purchase a house and you're planning to get ready to file your tax returns and you have some concerns, have your lender review your file, pre-qualify you, and let you know, hey, before you send in those tax returns, hey, will you be okay on qualifying with the income that you're about to show on a 2-year average, or the average that you're able to use, whether it's a 1-year or 2-year average. So these are all great things that we look at whenever we are going through a file, putting everything together. So if you're self-employed, make sure you reach out to your lender and get pre-qualified before you start searching for a house. Thank you for tuning in today. If you haven't subscribed, please hit the subscribe button, like this video. We will see you next time.